Gold is sitting at $5,174 per ounce this morning. You checked it. You saw the number. And if you're trying to make sense of it against everything else happening right now, the burning refineries, the blocked shipping lanes, the job numbers that just came out, I need to walk you through something. Because what is driving this price is not what most financial commentators are telling you. The headline story is simple. War in the Middle East, safe haven demand, gold goes up. That's the version you'll get on Bloomberg, on CNBC, on every mainstream outlet running a 90-second clip between commercial breaks. And it's not wrong. It's just the surface. The real story is what happens when three separate structural forces, a crumbling labor market, a paralyzed Federal Reserve, and a physical shipping blockade across the most critical energy choke point on Earth, all collide at the same moment. Because right now, that is exactly what you are looking at. Here is the number that should make you pause. According to Goldman Sachs's Commodity Desk Note, dated March 1st, 2026, there is already an $18 per barrel war risk premium embedded in crude oil prices, equivalent to a full 1-month closure of the Strait of Hormuz. That strait, the narrow waterway between Iran and Oman, carries roughly 20% of the world's daily oil supply and 20% of global liquefied natural gas shipments. As of this morning, over 100 tankers remain halted. At least 5 vessels have been damaged. 2 crew members are dead. Iran's Revolutionary Guard Corps has broadcast radio messages to ships in the Persian Gulf stating, in their exact words, that passage through the strait is not permitted. And this is day 9 of the U.S. and Israeli military campaign against Iran. 9 days in, and no sign of a ceiling. By the end of this video, you will understand 3 things. Why $5,174 is not where this ends, but where the real test begins. Why the Federal Reserve is now trapped in the most uncomfortable position it has faced in decades, and why the mechanism driving gold higher is fundamentally different from every previous geopolitical spike you have ever seen. Different in a way that makes historical comparisons almost misleading without the right framework to interpret them. Let's build that framework now, starting with the verified data from this week, layered in the order you need to see it. On February 28, 2026, the United States and Israel launched coordinated military strikes against Iran. The immediate aim, as documented by the Armed Conflict Location and Event Data Project, was the decapitation of Iranian leadership. That objective was achieved within hours. Supreme Leader Ayatollah Ali Khamenei was killed in an early Israeli strike on Tehran. The campaign, which the U.S. Central Command confirmed had struck more than 3,000 targets inside Iran in its first week, has since expanded to strikes across at least 26 of Iran's 31 provinces. Iran has responded with more than 90 attempted missile and drone strikes against Israel between February 28th and March 4th alone, a 5-day total that represents over 60% of all Iranian strikes recorded during the 12-day conflict last June. That comparison, from ACLED's own data, tells you something critical about the intensity trajectory. This conflict escalated faster, deeper, and more broadly than the previous engagement. The ripple effects were immediate and global. Hezbollah formally entered the conflict on March 2nd, launching strikes on Israel in response to Khamenei's killing. The Israel Defense Forces are now preparing a ground invasion of southern Lebanon. Iranian proxies in Iraq have launched attacks on Saudi Arabia and Kuwait, with rockets hitting oil installations in Basra as recently as March 6, where American companies have significant assets. Saudi Arabia's defense ministry confirmed it intercepted 16 drones heading for the Sheba oil field, one of the largest in the Middle East, in the early hours of that same Saturday morning. Gulf states including Qatar, Bahrain, and the UAE have seen fresh drone and missile strikes. Dubai International Airport was attacked multiple times, and Trump, writing on Truth Social, stated that Iran would be hit very hard, while a senior Iranian official told CNN that Tehran is now identifying new U.S. assets to target. This is the geopolitical backdrop for what you are watching in the gold market. And the mainstream explanation, safe haven demand from nervous investors, captures about a third of the real picture. Here's what the mainstream explanation leaves out. When the conflict erupted on March 2nd, gold did not simply drift higher on general anxiety. It surged nearly 2% to test $5,400 per ounce at the market open. Simultaneously, the Spider Gold Trust, known as GLD, and the world's largest physically backed gold ETF with $180 billion in assets under management as of late February, recorded its most significant daily volume in over 6 months. This was not retail investors buying on fear. This was institutional positioning, and it came on top of a structural foundation that was already in place before a single missile had been fired. Here is the data that mainstream financial media has almost completely ignored in its conflict coverage. According to research from State Street Global Advisors and the World Gold Council, physically backed gold ETFs added roughly 500 tons since early 2025, well above what Federal Reserve rate cuts alone would have predicted. Goldman Sachs's January 2026 analysis, authored by analysts Don Stroyven and Lena Thomas, described that excess as evidence of structural reallocation, not tactical positioning. The People's Bank of China extended its gold purchases for a 15th consecutive month through January 2026. Goldman Sachs forecasts central banks will purchase an average of 60 tons of gold per month through 2026, sustained by emerging market reserve managers systematically reducing their dependence on dollar-denominated holdings. The World Gold Council's data shows global, physically backed gold ETF holdings reached 4,145 tons by late 2025, a record, while total ETF assets under management topped $669 billion. In other words, before Iran was bombed, before Khamenei was killed, before the Strait of Hormuz was blocked, the structural bid for gold was already unprecedented. The geopolitical shock did not create the gold bull market. It landed on top of one that was already running at full pressure. This is the piece that most analysts have missed in their week-by-week conflict coverage. When BNP Paribas Director of Commodity Strategy David Wilson stated in a Bloomberg television interview that gold could reach $6,000 per ounce by year-end, he was not making that call in response to the war. He was making it before it. The war is not the story. The war is the accelerant. Now here is where the picture becomes genuinely complicated, because this week introduced a tension that the gold market has not fully resolved, and understanding that tension is what tells you what to watch in the next 72 hours. On Friday, March 6th, the U.S. Bureau of Labor Statistics published the February employment report. Total non-farm payrolls fell by 92,000. Economists polled by LSEG had expected a gain of 59,000. The miss was 151,000 jobs in the wrong direction. The unemployment rate rose to 4.4%. Revisions to December and January combined removed a further 69,000 jobs from previous figures, meaning December, previously reported as a gain of 48,000, was revised to a loss of 17,000. The three-month average payroll change, according to LPL Financial's chief economist Jeffrey Roach, is now 6,000 jobs. The six-month average is negative. Federal government employment alone is down 330,000 from its October 2024 peak as DOGE-driven cuts take effect. Mary Daly, president of the Federal Reserve Bank of San Francisco, told CNBC explicitly, "We also have inflation printing above target and oil prices rising. Both of our goals are risks now." That sentence is the pivot point, because what Daly was describing is stagflation, a weakening labor market coinciding with rising energy-driven inflation. And stagflation is precisely the environment in which the Federal Reserve has no clean policy response. Rate cuts would support the labor market, but risk inflaming inflation already being pushed higher by $82 Brent crude. Rate holds protect the inflation fight, but abandon an economy that just shed 92,000 jobs in a single month. The CME FedWatch tool, which tracks futures market pricing, shows a 95.5% probability the Fed leaves rates unchanged at the March 17-18 meeting, with the next cut now being priced for July at the earliest. That is a significant shift from earlier this week, when markets were pricing 2 cuts before year-end. And here is the mechanism that the mainstream narrative consistently gets backward. A strong dollar and rising gold are supposed to be inversely correlated. When the dollar strengthens, gold should weaken, because gold is priced in dollars. The DXY, the US dollar index, hit a near 5-week high of approximately 99 during this week's conflict escalation, its strongest level since late January. Yet gold, after a brief 4% correction on Tuesday when the dollar claimed the safe haven trade, has recovered to $5,174. Both assets are elevated simultaneously. That breakdown of the traditional inverse relationship is one of the clearest signals you can observe in this market. It tells you that investors are not simply choosing between gold and the dollar as competing safe havens. They are buying both. When that happens, it is because the underlying risk being hedged is not priced in either currency. It is the risk of a structural repricing of all fiat-denominated assets simultaneously. You can print contracts. You cannot print the metal itself. That is the core of what is happening here. The paper claim on gold, through futures contracts, ETF shares, unallocated accounts at bullion banks, has been expanded for decades on the assumption that physical delivery would never be simultaneously demanded at scale. That assumption has been stress-tested before. In 2020, COMEX delivery premiums spiked as COVID disrupted refinery logistics and the arbitrage between London spot and New York futures temporarily broke down. In March 2008, During the early phase of the financial crisis, silver premiums on physical delivery spiked dramatically above the paper spot price as buyers discovered that the paper price and the deliverable metal were not the same thing. But in both cases, the stress was resolved within weeks as supply chains normalized. What is structurally different today is that the demand side, central banks, ETFs, Asian retail investors, has been absorbing physical supply at a rate that, according to Goldman Sachs, corresponds to roughly 60 tons per month in central bank purchases alone, on top of the 500 tons of ETF inflows since early 2025. The physical float available for new buyers has been shrinking throughout the entire structural bull run. The geopolitical shock has now added acute short-term demand on top of a market that was already structurally tight. Now, let's address the legitimate counterargument directly, because it deserves a fair hearing. The bearish case runs as follows. Geopolitical spikes in gold are almost always temporary. The 2019 Abqaiq attack on Saudi oil infrastructure, the largest single disruption to global oil supply in history, caused a gold rally that faded within 3 weeks as supply was restored. The 2022 Russian invasion of Ukraine caused a $200 per ounce spike that reversed within 6 weeks. The pattern is consistent. Fear drives acute buying, resolution or de-escalation drives profit-taking, and gold returns to its structural trend. If the US and Iran reach a ceasefire, and there are reports that Oman had secured concessions from Tehran before the strikes even began, with Iran reportedly agreeing to limit its uranium enrichment program, the geopolitical premium in gold could evaporate quickly. Goldman Sachs itself, in its March 1 commodity desk note, maintained a base case Brent crude forecast of $60 per barrel by Q4 2026, assuming no sustained disruptions. Lombard Odier's chief economist, Sami Char, described the current conflict as likely following the usual pattern of a short-lived but more intense spike in oil and gas prices. If oil stabilizes, the inflationary argument for holding gold weakens, rate cut expectations return, and the dollar softens, which is historically the cleanest bullish scenario for gold on a 6-month view, but at lower starting prices than today. That is the honest bearish case, and it rests on a real premise. De-escalation is possible. The US and Iran were reportedly in indirect talks through February. Gulf states, including Qatar and the UAE, were actively lobbying Washington against using their territory for strikes. The ceasefire pathway exists. Here is what that counterargument does not account for. First, even in the base case, the Lombard-Odier scenario of limited escalation, inflation projections for 2026 have moved materially. Their base scenario now projects U.S. headline inflation rising from 2.5% to 2.6%, with the Fed holding rates rather than cutting. That alone removes the rate cut tailwind that was supporting gold's pre-conflict trajectory. Second, the structural bid, central bank purchases, ETF inflows, de-dollarization, does not depend on the conflict continuing. Those forces were in place before the first missile flew and will remain in place after a ceasefire. The conflict is the shock on top of the structure. The structure itself is what BNP Paribas' $6,000 year-end forecast and ANZ's $5,800 Q2 forecast are based on. Third, and most importantly, the February jobs report has now created a macro condition. Stagflationary pressure, a paralyzed Fed, and a labor market shedding jobs that is genuinely different from the 2019 and 2022 analogs. In both of those events, the U.S. economy was in expansion mode, and the Fed had clear policy optionality. Today, it does not. The framework for the next 72 hours is specific. Here are 3 things you can verify yourself with publicly available data. First, watch the U.S. Consumer Price Index report scheduled for release on Wednesday, March 11th. This is the most critical near-term data point for gold, because the CPI will capture some of the initial oil price spike from the conflict's first days. If headline CPI comes in above the expected 3.1% year-over-year reading, it will further constrain the Fed's ability to cut rates and simultaneously validate the inflation hedge argument for gold. The moment that report posts, you will see the futures market reprice. If CPI surprises to the upside, the next resistance level for gold, the January intraday high of $5,594, becomes the near-term structural target. Second, monitor the Federal Reserve's March 17th through 18th Federal Open Market Committee meeting. The CME FedWatch data shows 95.5% probability of no rate change. What matters is not the decision, but the press conference statement from Chair Jerome Powell. If the Fed signals that energy-driven inflation will influence its timeline for the next cut, particularly if it pushes the anticipated first cut beyond July. That is a structurally bullish signal for gold on a 30 to 90-day horizon. If Powell threads the needle and preserves the July cut as base case despite the inflation risk, gold may consolidate briefly as traders reassess. Third, track shipping activity through the Strait of Hormuz. Lloyd's List and other maritime intelligence providers publish daily vessel movement data. Currently, with over 100 tankers halted and war risk coverage suspended by marine insurers, shipping is at a near halt. If vessel movements resume materially, say 30 or more tankers transiting successfully within a 48-hour window, that would signal that the de facto blockade is cracking, oil prices would fall, and gold's geopolitical premium would come under pressure. Conversely, if Iran damages or seizes another vessel in the next 72 hours, the $82 Brent ceiling tested on March 2nd becomes a floor, and Wood Mackenzie's $100 oil scenario, the one that Goldman Sachs' own analysts described as the tail risk requiring full Hormuz closure for a sustained period, begins to enter mainstream market pricing. Markets can do things that defy the structural data. Positions get unwound, margin calls happen, buyers become sellers for reasons that have nothing to do with gold itself. That is true. Acknowledge it. Price it into your thinking. But here is the synthesis that the data points toward, and it is worth stating calmly and precisely because it does not require the conflict to continue escalating to remain valid. The gold market entered 2026 in the midst of a structural realignment that had not been seen since the early 1970s, when Nixon's closure of the gold window in August 1971 permanently severed the dollar from any physical anchor. That event, like this one, was framed by most contemporary commentators as a temporary policy measure, a technical adjustment, something that markets would absorb and move past. Instead, it marked the beginning of a decade-long repricing of gold from $35 per ounce to over $800 per ounce. The conditions today are not identical. The dollar is not formally on a gold standard. There is no single policy decision analogous to closing the gold window. But the underlying dynamic, a loss of confidence in the ability of fiat currency and sovereign debt to preserve purchasing power, expressed through systematic sovereign and institutional accumulation of physical metal, is structurally parallel. The difference today is that the demand is being concentrated in a market where the free float of unencumbered physical metal has been shrinking for years. The conflict in the Middle East has compressed what might have been a 12-month price discovery process into potentially a matter of weeks. That is not a prediction. That is what the structure of the data suggests when you read it without the editorial overlay that most financial media applies. The number you are watching on screen right now, $5,174, is the market's current assessment of all of the above, priced in real time, under conditions of genuine uncertainty. Whether that number is a ceiling or a floor in the near term depends on three pieces of data you can now go and check yourself: Wednesday's CPI, the March 17th FOMC statement, and daily maritime intelligence on the Strait of Hormuz. Given that the February non-farm payrolls came in at minus 92,000 against an expectation of plus 59,000, the third month of job losses in 5, and given that oil is simultaneously pushing toward a 14-month high on Hormuz disruption fears, where do you think the Federal Reserve's credibility sits in 3 months' time? Drop your honest assessment in the comments. Not a price prediction, your reading of the Fed's actual policy optionality in a stagflationary environment where both sides of its dual mandate are moving in the wrong direction simultaneously. The most interesting analysis gets pinned. The CPI report is Wednesday, March 11 at 8:30 Eastern Time. I'll have the analysis up Tuesday evening before market close, connecting the print directly to the Hormuz shipping data and the FOMC positioning. Subscribe with notifications on. If that data hits the way the current trajectory suggests it might, the Tuesday analysis is the one you will want to have read before the open. Everything in this video is sourced from publicly available data: BLS employment figures, CME FedWatch tool, Goldman Sachs' March 1st commodity desk note published in press coverage, ACLED conflict data, Lloyd's List maritime reporting, JM Bullion and Kitco spot price feeds, and institutional forecasts from BNP Paribas, ANZ, Morgan Stanley, and the World Gold Council. All sources are linked in the description. I am not a financial advisor. Nothing here is investment advice. Verify every number yourself, make your own decisions, and treat anyone who claims certainty in a market this volatile with the appropriate skepticism, including this channel.